Really, like I would say, I'll get one of these, swing for the
The
fences
shadows
scenarios
creep
once
close.
a month.
Keep your guard up. How are you
Okay.
planning to outsmart these
But it will be
foes?
you have a lot of clustering. Like I would have maybe 10 of them, or maybe even more in February, and then none in the past 3 months.
Right. Yeah. Yeah. It's just a factor of the market conditions, I guess.
Yeah, exactly. Like when the volatility is low, no one's panic selling out their small cap illiquid stock on a foreign exchange.
If someone's listening to this and they're just a self-directed retail trader, I mean, is this the type of trade that that would be worthwhile exploring for them? Or, you obviously have, some advantages of the, with brokers and access and that type of thing.
Mm-hmm.
Like, how feasible is this, or realistic is it for, a at-home trader to replicate this to a certain extent?
I think it's extremely hard to replicate, but it doesn't mean that you can't take advantage of it. The infrastructure required for this is pretty onerous setup, and like even as an institutional trader, it's a lot of work. But as a retail trader, you can take advantage of if you see, if you're a retail trader trading BHP, you can look at what BHP did overnight. Is it trading at a premium? Is it trading at a discount? Was BHP up 5% overnight? And then maybe adjust your price accordingly. And then, for example, we have if you see POS trade at a massive discount in Germany overnight and a lot of shares get done, you can kind of assume someone has bought a lot of shares, and that someone needs to offload those shares the next day. And you can kind of say, oh, okay, there could be some selling in POS today.
If we just move on from this now, there's one other area I'd like to get in with you. And that is, I guess, talking about how you think about, because obviously what we've spoken about here is just kind of a couple of your plays, right? A couple different strategies that you implement. And the thing which is so interesting about you, James, is that the strategies that you trade and the edges which you exploit, they're quite unique.
Yeah.
And they're more or less sort of market neutral to a certain extent. And if they're not unique, they're certainly strategies which a lot of retail don't necessarily have exposure to or aren't familiar with.
Mm-hmm.
So I'd just be interested to kind of ask you a bit more about how you think about finding alpha and how you actually think about getting an edge. And I know there's an acronym that you use. So I was maybe going to just ask you if you'd like to step through that.
Sure. Just briefly, I think if you're trading the same way as everyone else, you're going to get average results unless you are like a prodigy or something. It's much easier to compete in places where other people don't, won't, or can't. If you're trading in your own niche, you're much more likely to succeed because you're just simply facing less competition. I stole this from Angus Cameron at Liminal Capital, who explains edge with a very nice acronym. It's Asia, and like all good acronyms, it has several letters repeated. So the acronym stands for access, speed, information, and analytics. So access, what I mean by that is you have access to other markets. For me, it's ADRs, right? I get to trade in the German market. I get to buy PLS in Germany. I get to buy Oceanic Gold in Canada, right? So this is an edge in itself. It could also be access to liquidity when no one else can get. It could be placements. It could be IPOs. It could be favorable treatment in special crossings. So access itself could be edge. There could be funds that are making money off their broker relationship, just doing IPO after IPO after IPO. Next one, speed. Pretty self-explanatory, is just reaction to info. Like maybe it could be order speed. Maybe you're always scanning Trader News or Squawk Box or Bloomberg or Reuters, and you always see the latest headline first, and then you'll be the first one to smash an order in when everyone else is still reacting. Next one I want to talk about is information. Like information as in it could be data, news, opinion, or flow. Any kind of information that no one else has. It's slightly related to speed because information kind of diffuses very quickly into the market. Like it could be a broker upgrade or downgrade that you just heard straight from the analyst. And it could be, like something that only you know about because it's your niche, like an index rebalancing or something like an intraday ETF flow mechanics that you're very familiar with and the rest of the market doesn't know about. And the final one is analytics. It's a little bit like information, but this is, I guess, this is your own set of understanding, like your own set of understanding, like how you think things will react to events. Like it could be as simple as like you can outsource. Like you could, an event can happen and you call the analyst in the stock and they will give you color on whether this is bearish, bullish, whether it's priced in or not. It could be being prepared for an event. Like for example, last year when there was talk of an ETF going through for Bitcoin, those who did all the prep work and had set up all the alerts on various news wires were able to buy Bitcoin instantly when the news hit the wires, while everyone else was scrambling to see is this news legit? Which wire did it come from? What will it mean for the ETFs? Will this have second order effects? So pre-gaming can be a source of analytics as well because you have pre-done all the analytics where everyone else is still thinking of the questions that you have answered months ago.
Point. Pre-gaming. Can you talk about, back testing and, or not just back testing, but just general testing of your system to know whether an edge exists or not? Is that something you do much of? Obviously some of these things that you talk about here, and, as still a discretionary trader, even though some aspects are systematic, discretionary trades can be quite hard to, test rigorously. But what kind of testing do you do? I guess this kind of ties into analytics a little bit.
Basically, any idea, any correlation or relationship. A lot of trading has these rules that people take for granted that actually don't really hold true. And a lot of it are seemingly like common sense rules that might not actually hold water. An example I'll give is you see gold go up, right? And they expect gold stocks to go up. It makes sense in theory, because gold miners produce gold. They, then they sell the gold. If the gold price is up, they make more money. But if you test the performance of various gold stocks against gold itself, you might find out that actually some stocks don't actually react really well to a gold price. It could be because they're hedged or something, right? Or it could be because like a whole variety of different reasons. Like for example, Australian gold stocks might actually be performing worse because of the Aussie dollar component. Like gold could be up, but the Aussie dollar could be up more, meaning the gold price is actually down in Aussie dollars, and these Aussie denominated miners are actually selling gold at less than what they did before the move. A lot of these seemingly, I guess, basic rules in trading, I think people need to cast a closer eye on them, because a lot of them is like they simply don't work.
Can you speak or maybe just give some guidance to, let's say, again, a self-directed retail trader at home who's maybe been at this a couple years, maybe still trying to find their groove, feeling a little bit lost, trying to find some of these more obscure edges that, sort of take a page out of your book. Obviously, they don't have the same access that you do. But Is there any guidance you could give to someone in that position for where they might be able to, seek out a little bit of alpha?
Playbook everything. And then once you playbook something, try to do a back test if you can. It's just screen time in the market. You notice something weird that's going on, and then it's just a pattern recognition. Does this thing happen and again and again? If so, maybe do a back test on it. For example, if again going back to the previous point, most traders that follow most day traders, right? They'll buy a stock during the day and sell them the next morning. Sure, you're at risk of gaps, but over the long term, maybe you'll be able to make 10% more every year if rather than selling at the close, you always sell the next morning. Stuff like that. Anything you see that you feel is a bit, this is strange. I wonder if this is a pattern or it's just a random scenario that might never happen again. If you keep recording it, testing it, and seeing, if something like this can happen again or has happened in similar markets, you establish kind of like a mental model of how markets operate. And if you backtest everything and all these assumptions about the market, you can, I think, form a very good understanding of how markets actually operate.
Yeah, I love that answer. And I love that you said, if you see something that looks a little bit weird, I think that's actually really key. So just as we wrap things up here and sort of move towards the end of our discussion, there is one more topic which I would like to bring up, and that's your more recent sort of involvements in crypto. Like, what's the attraction there?
I first traded crypto, I think, in 2015. Didn't really understand what's going on. Traded a bit as a retail, got in, got out. The environment wasn't very friendly for trading. The commissions were huge, spreads were huge. It's only recently I've kind of started to recognize that despite what you believe what crypto is or what it isn't or what it can do, it's like a fantastic trading environment. You're always trading against retail rather than institutions. Like there are institutions coming in, but you tend to not face the same kind of competition as you do in equities. And it kind of goes back to the previous part where if you can find a niche that isn't crowded, you should definitely explore that niche. If you're always trading in an environment where you have minimal competition, where you're not competing against 10 other traders to fight for this, the best price, to fight for the best tick, and then the flushes because the thing flushes because everyone is in the same crowded trade. It's a great place to be. It's kind of like you could be the best poker player in your town or in your city, but then poker has been shrinking in the past couple of years, and eventually start all the easy opponents, so to speak, have left the game, and eventually start playing against harder and harder opponents, and you have to work very, very hard for a smaller slice of the pie, or just to keep standing still. If the pie is growing exponentially and all this dumb money is coming in and all these institutions are coming in, you can get away with just lazing around and just doing, or maybe not specifically lazing around, but you can get away doing very little, or even applying what you already know. Get away doing very little, or even applying what you already know.
So what you're saying is crypto is a lot more inefficient than stocks.
It's a lot more inefficient than stocks. An example I don't mind sharing because this edge will be gone soon is Ethereum tends to be a proxy. It tends to be a proxy of the Nasdaq. And 6 months ago, it will, during like big moves in the Nasdaq, it will lag Nasdaq by like minutes. It was absolutely ridiculous. Now, especially recently in the past couple of months, it will still lag the Nasdaq by a couple of seconds, which anyone who trades futures knows is a massive advantage. Like especially when it's a big inflation print, and the futures move, the ES moves, the Nasdaq moves, crypto will move a couple of seconds behind all that. there's been a lot of I've definitely seen a lot of arbs have come in to try to reduce that to even lower and lower speeds, but there's still like a little bit of time left. I'm pretty sure in 3 months or whatever, like this entire thing will be gone, and have to move on to some other source of alpha.
Yeah. See those that sort of example is like exactly why I was so keen to have you on the podcast. Like just those sort of unique little edges. How did you uncover that? Like, how did you spot that? How did you spot that weird little thing?
I was waiting for the inflation print, and then saw the print. Inflation was higher than expected. Markets get smashed, and then I realized I was like, oh my god, I'm long XYZ coins. And it's like, and then I log in to check them. I was like, oh, it hasn't moved yet, and then it started moving. I'm like, oh my god. Cut, like DMA, just cut these things, and then I see it start moving, and it's like, what the hell's going on? And look back over the past and say, oh my god, there used to be a 5-minute delay, and it became 1 minute, and then it became a couple of seconds.
Yeah, and by the time this comes out, it'll be gone.
Yeah, I'm sure. Jump Crypto will be all over it.
Yeah. Just to wrap this up here, James, I know that you're actually looking to hire somebody. Do you want to just give a little bit of information about who you're looking for, who should apply, how to apply, etc.?
I've been trading ADRs for probably a decade now, and I would like to sleep one day. And because I'm always up at night trading the US, it's a lot of fun, but I often can't keep track of everything that goes on, especially if I have to keep track of what's going on in Europe, keep track of everything that's going on in Australia as well. So I'm looking at someone to basically start off as a support trader for me in the US, tell me what's going on, and may eventually start placing trades for me as well.
Okay, and this would be someone who lives in the US, right?
Yeah, I did because I wanted someone in the US because I wanted this to be a long-term position. I understand full well what happens if you stay up every night trying to do everything. You get burnt out very quickly, or you stop caring when the alarm goes off at 5 a.m. It's just not a long-term solution to have someone in Australia.
That's something I was going to ask you earlier, actually. It's like, how do you monitor all this? Like, you've got the Australian market during the day, and then US, or Europe, I guess, is early evening.
Yeah.
And then US, like, right through to the morning. Like, how do you manage it all at the moment?
It's bursts of activity and lots of, I guess, do nothing in between. So I do stay up fairly late to trade it. So it's quite taxing in that sense, but then I enjoy it immensely. Watching the markets, figuring stuff out, and I guess it's like the ultimate game.
Yeah. So, okay. So, just on the person you're looking for, like who, what sort of levels of experience or anything like that, any more details you'd like to share?
Yeah. So someone ideally with good US microstructure experience. ADR experience is not essential because it is quite a niche field. Someone who's decent at short-term trading and understand the intraday drivers of a stock. I'll make a Google Forms sheet with a couple of the specifications.
Okay. All right. So that's probably the best way to apply is just through the Google form.
Yeah, that'll be best.
Well, I will set up a link. I'll pop a link to that in the show notes. How about that?
Sounds good.
Folks listening, if you'd like to get that link, go to chatwithtraders.com/231, as this will be episode 231, and you'll find a link there in the show notes.
Awesome.
Cool. All right, James. Well, I just want to say I'm so glad we could have this conversation. It's great to have finally had you on the podcast. It's been in the back of my mind to reach out to you for a long time. And anyway, I'm glad we could make it happen. So thank you.
Absolute pleasure.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Traders, thanks for joining me here on episode 232. And this episode is another trade recap. That means it's a shorter episode with the sole intent of analyzing step by step how my guest went about putting on a single trade, or rather, in this case, it's multiple intraday trades. And my guest is no stranger to the show. It's my guy, Nishant Purbandawala. Nish is a senior equities trader at Kirshner Trading Group in Austin, Texas, who's been active in markets for more than 15 years. As I alluded to, Nish has been on the podcast several times before, and each time it's been a seriously good episode. If you haven't heard these already, you certainly should. Check the show notes for links. chatwithtraders.com/232. For this trade recap though, Nish details how he booked an outsized six-figure profit trading DWAC, the NASDAQ-listed social media SPAC with ties to Donald Trump. The date was 22nd of October 2021, the day it traded from $50 up to a high of $175. So that you have a visual aid to follow along while listening, Nish has provided a price chart with his executions. Again, you can view this in the show notes at chatwithtraders.com/232, where I've also summarized each of the main trades into a list. Hope you dig this one. I will now pass you over to Mr. Purbandawala. So let's break this down. This was an outsized winner for you. The first thing I'd like to ask is really about identifying the opportunity. So how did this stock get your attention? How did it appear on your radar?
The first time it appeared was on October 21st, the day before it. So some context to, and I'm sure most of your listeners would know of DVAC because it is the Trump SPAC that came out. Basically, they want to be the Twitter for the Republican Party or for Trump, and therefore they became this sensation when it came out and when it merged with a SPAC. Just like many other people, not to get political at all on this, is that I thought this was pretty much BS. I was like, dude, there's no way. And the way SPACs were moving those days, like anything would move up, So I'm like, oh yeah, okay, let me just play it a little bit here and there. So let's start with October 21st when the news came out. This company, Truth, which is what's called now Truth Social, is going to merge with DVAC. And I saw so we start with the morning imbalance, which is at usually at 9:25 Eastern time. It was a million share imbalance, okay, and the stock moved up from that about 30 cents, opened at about $12.77.
Can I just pause right there? when you say there was a million share imbalance, can you just explain what that means?
So every stock has an imbalance. That means there's X number of buyers, X number of sellers. It's an auction that happens every day before a stock opens, right? To determine what price the stock should open. You don't really see, you see the opening print in every stock. That's an auction, basically. This the amount of buy orders and the amount of sell orders equates to a certain price where the stock should open. Okay. So for a stock like this, which was a SPAC, every SPAC is at $10. This was opening at about 1277, a million shares. I was like, I'm going to short the print because it's moved up on that imbalance. Basically, there's a million shares that wants to buy it, and I was like, I don't think this goes too much. So I shorted 5,000 shares. As soon as it opened, it spiked about $1 to about 1377. I shorted more. I think I was in 20,000 shares by that. I was down in the trade. It came back down a little bit. I was kind of flat. I said, let me just get out. This has done something more than it should have done. So I got out, I think kind of, down maybe a couple of grand in it. And I said, that's not bad. Let's just forget about it and let's just trade the market. At 10 a.m. that day, it started moving up a little bit and kind of broke that 1377 level, started pushing higher. I played in and out of it. I was like, really, is this really going to go up? It doesn't make any sense. You have that. Everyone has a small bias. End of the day, I was like, no, it doesn't make sense, dude. I mean, not that Twitter was doing that well or anything that moment. So I'm like, okay, whatever. This is just a SPAC just for Trump and his way of because he was banned from Facebook and Twitter and this and that. This was his way of just putting his comments out there. I said, how can they make money? So you start thinking about all these things, and you're like, okay, it doesn't make sense. So I traded in and out all day of it. By the end of the day, it closed at about $50. Okay, so and I went back and I checked, and I lost about 23,000 in this stock.
Okay, so that's day one.
Day one, yeah. I think I traded about 150,000 shares in it. In and out, in and out. As it halted a few times also, and I'm like, what? I've totally messed this up. I've thought about it and I have a bias, and instead of just trading the way it should have traded, I should just get my bias out and just trade it. I don't want to think about, it's Trump's IPO, it's Trump's SPAC, or this is a dumb idea, or any of those things. And then I don't know. I remember one person talking to me. He's like, the dumbest ideas go up the most. That's how the market was trading at that moment. There was dumb stocks that were going up like crazy, like SPACs especially. These SPACs are now down like about 80 or 90%. Usually most of those ones like IRNT and all these different names. Anyways, that was day one, and that was the identification of the trade. Comes day two, which is October 22nd. I wake up early because I wanted to, get some shares of the stock. The stock has gapped up to 70, 77 when I see it. I'm like, again, the little bias is always there. So I'm like shorted like 200 shares just to watch it. I'm like, this is pre-market. It's about 6:30 in the morning, Central Time. The stock goes up about 85. I'm like, what? Let me get out, take my losses. Let me reconsider once closer to the open. So then I look at the open and I'm like, again, I'm seeing a humongous imbalance. And now the stock is capped up to 80, as I said. There's a 1.6 million share buy imbalance, right? So there's 1.6 million shares that want to be bought. It could be market orders, it could be limit orders, it could be anything. But there's also sell orders on the other side. But the auction is such a way that right now 1.6 million more buyers than sellers, right? And so it's going to find a price to open where 1.6 million shares get enough sellers to equate it to zero in a way. Make sense?
Yep.
So I'm like, that's a pretty big imbalance, and the stock has increased in price a lot. So I'm like, you know what? I'm going to buy. So at about 9:25 Eastern time, about 6-7 minutes before the open, I start buying at, I think 92, I buy some. I buy at 97, I'm buying some. The stock is moving up and up and up. And I'm like in about 5 or 6,000 shares pre-market. I'm like, okay, fine. I'm going to sell the whole thing as soon as the market, as the market opens. There's a way to sell it at open. And so from the time I was buying at 92, the stock opens at 119.91 cents, right? So it opened about whatever 20 odd 22 23 points from where I got in. So it was up about, I don't know, I think I took out some profits while it was going up because it was going up so quickly. I didn't think that it would really, that imbalance would actually stay. I thought it would actually get, covered. So I was taking profits as it was going up. Also, I had some orders to, on open to sell. So I did that too. So I sold at 119.91. So I think it was up like 60 or 70K by then on 5 or 6,000 shares. I know a friend of mine who was trading, he was in, I think, 20,000 shares. I think he was up like 250 just before the market even opened. Do we have a next question, or should I keep going through my story?
Yeah, so let me just ask a couple questions. Your first trade, when you were quite early to this, when you were shorting in the pre-market, is that something you do often, or was this kind of an exception to the rule?
Oh no, I do trade a lot. I mean, especially the way the market was going on in October and all the way from like the COVID times. Waking up at like 5:30 or 5 in the morning was a given now because there was so much activity happening pre-market that you had to be awake. And sometimes, if you want to secure shares to short, you would wake up early in the morning and just secure the shares that were going crazy, like small caps that were going crazy, or stocks like DVAC that were going crazy. You wanted to go and secure them. So waking up early in the morning was something that we were doing consistently in the pandemic.
Okay. So I just want to maybe clarify, what were some of the variables for why you decided to go long the stock in the pre-market just before it did open there? Like, what were some of the key things which you identified, some of those repeatable factors that made it like a clear long trade for you?
Right. So it goes back to the day before when, I knew that there was a million share imbalance. It had moved the stock a little bit anyways. So, and now the stock has momentum. It's, closed at 50. It's gapping up. The imbalance is still there. You don't know exactly if it's going to open where. If it's going to open at 120, you're going to open at 100. But I'm like, what, this imbalance is going to push the stock to a decent level where I'll make some money. Right now, if I knew it's going to open at 120, it's going to open 20, 25 points up, I would be in way more shares. But, at times, I mean, hindsight is 50-50. But, usually if you see an imbalance like that, you're like, yeah, it's going to open maybe 3 or 4, 5 points up. I didn't expect to open 20 points up from where I got in. So that's why I took profits throughout that move up. In 5 minutes, I did take profits. I mean, I think by the end of it, I think I only closed about 2,000 shares at the opening print.
So talk to me about, I guess it's maybe trade 2. It looks like the stock halted shortly after the open.
Yeah, I think it halted 34 seconds after the open. Yeah, so I got out of my shares at the open. I said, let me see what it does, because even yesterday, even the day before on October 21st, it opened and it spiked up, right? And I was going to be caught in the spike, so I won't short immediately, but I do want to short, in the end, for sure. But I was like, let me just trade the stock. I don't want to have that bias, which I carried on day one. I said, let's just see what it does. Let's not think about anything. Let's just see what it does. And so in 34 seconds, it hit LRP. Do you know what LRP is?
No, I don't. I presume it's some sort of regulatory hold.
Yeah. So LRP is basically if a stock moves X% in and hits this level, like I think it moves 5%, and it's there at this level called the LRP, which is a point where it halts. If it stays there for 30 seconds, the stock halts. Okay.
Okay.
So it's a moving average of 5 minutes, 5 minutes for 5%. So if it moves within that 5%, it halts at this level. But it has to be at that LRP for 30 seconds. So as soon as I hit the LRP, I said I'm just going to buy it because there was so much buying in the starting. I'm like, and it was going up, and I'm like, okay, fine, I'm just going to go with the trend. So I bought it, and I bought, I think, 3,682 shares.
Okay. So did you buy it thinking that, knowing these rules for when the halts occur,
Oh yeah,
presuming that there was soon to be a halt?
oh yeah.
So that was kind of the trade there. That was kind of
I
the
was like,
idea.
if it's halting, I'm going to go with the trend.
Okay.
I didn't know what's going to happen after that. Usually on halts, like it's an up halt, right? So usually on up halts, you usually don't lose money that much. So it's like maybe it can open down a little bit at times, or it can open up a little bit, right? So you take a 50-50 shot. It's like, you know what? Let's just go with the trend and see what happens. So that's what I did. As I hit LRP, I said, you know what? I'm going to add as many shares as I can, but I don't want to be in too much size because just in case if it goes against me, I don't want to lose all the money I made in the morning. So let me just, get in as much as I can. So if you see the number I got, it was 3,682 shares. So I was trying to get in more, but you have 30 seconds to try to get in, and the whole world is trying to get in at the same time. So it's not like it's an easy way to get in, but there are tricks and trades of how to get in.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading, Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit, and move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more, all in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Hon, sorry, can I just interrupt you?
Yeah.
Again, I don't trade these markets on an intraday level, so some of these nuances I'm not familiar with, but I presume that's probably the case for quite a few of my listeners as well. So if you said that the stock was going, you could see that by the way it was trading that there was going to be a halt occurring shortly. But you said there was a 30-second window for you to try and get in. What's that 30 seconds relating to?
Well, let me explain. I didn't know it's going to halt up, right? As soon as it opened, the stock went up, right? So in 34 seconds, it moved up to the LRP. LRP is a point. It's called liquidity replenishment point or something like that. I forgot the real name for the abbreviation. So if it hits that point, and it's there at that point for 30 seconds, the stock halts for 5 minutes. Okay. So basically it hit that point, and as soon as I hit that point, I'm going to start buying at that point for the next 30 seconds before it halts. So I bought 3,600 shares, and this was at 131.90. That was the price it was trading at. Now it opened at 120, so it went 11 points pretty quick. In 34 seconds. So it was like just open, zipped up, halted, right? And then the imbalance came in for the halt, because again, you need an auction to open the stock. And if the stock is opening above 5%, it takes 5 minutes. If it's opening 10%, it takes 10 minutes. And if it's opening anything above that, or 15 or 20%, it takes about half an hour sometimes. I've seen sometimes an hour go by and the stocks don't open when it's really opening up.
Oh, right. Okay. So the
Yeah,
halt's completely dependent on the imbalance.
it's completely dependent on the price it's going to open.
The price, yeah.
So if it's going to open 5% up, then there is a 5-minute halt. And if it's 10% up, it's a 10-minute halt. And anything above that, usually it's like, could be 15 minutes. There's no real science to it, but this is approximate what usually happens. So I was in it, and then I see all these buyers, piling in, trying to get in, obviously, but the stock is halted. You start seeing an imbalance that's formed, right? So basically, what it's saying is that the imbalance, there was a buy imbalance of 1.4 million shares. So there was 1.4 million shares that had to be bought or wanted to be bought as soon as the stock opens, right? They're basically market orders, they could be limit orders, they could be whatever kind of orders, but this is how much they want to buy as soon as it opens. And I'm already long in this stock. So I'm waiting for the stock to open. And the way imbalances work is that they start printing a price where the auction is meeting right now. So it started at like 200, went to 180, went to 190, went to 165. So it was halted for about 30 minutes. And then it opened at 175, which was about 44 points up, right? And so I'm actually thinking of, okay, I'm going to short the print, but I didn't want to short a lot of the print, right? So it could open in 25 minutes, it could open in 20 minutes, it could open in 30 minutes. We don't know exactly. So you keep putting orders out in case if it opens and you can get it, right?
Yep.
So anyways, opens right there. So that was my big money gain out there.
Okay, so hold on, let me just interrupt you. So you're talking about considering shorting the stock now. So I presume that once it came back online, you sold your long position?
Yes.
Okay. And that was purely just because of the size of the gap?
Yeah, I'm like, if something gaps 40 points up, you take that profit.
Sure.
And
okay.
If it halts again up, you can always get in maybe a little bit and try that. But I mean, I know like that's a pretty big gap, and then this morning it was trading at 80, it's trading at nearly 100% up. Obviously things can go even more north from there. It's all possibilities, but then you just have to take what you see. As I said, I won't have a bias when I trade this. That's what I told myself. Anyway, that opens, and I think I told myself I'll take 500 shares short just to see if I'm wrong. If I'm wrong, I'm going to get out immediately, right? But it opened at one, maybe I got like, I think 700 or 800 shares. And then it just, went lower and lower and lower and lower and halted, I think maybe 3 or 4 times.
Into that part of it, this big trade. So the short, I know you said you didn't get as much size on for the short trade, but it does look like you were kind of adding to your short through the halts on the way down, or leading into the halts on the way down. I mean, is that where the majority of your money was still made? Like, did you get enough
after that? Like, it gapped out like every 3 or 4 points after that.
Okay.
It's like it's a 10, 15 point move, and it's really quick. And so it's like, you just have to know that like the main trade is over, because the move up is done, the move down is done. Now it's it's going to be range. It can be up, it could go down, it could go up, it'll go down. I don't want to put size on that, at least. I don't mind trading it with with a lesser size, just because you're a compulsive trader.
I think what you said there is the main trade is over. I think that's like a really key point that a lot of less experienced traders don't really accept as much. It's like sometimes when you have such a huge move or such a big event like that, right. It's like
one day when GME went to like 400 odd pre-market, and then opened and did its hits up and down, and then suddenly had a few up moves, and then it crashed down, and and then it just halted and halted and halted and halted every time. And then once it halted on, you have to really choose the amount of size you really want to put for a quick day trade,
I guess just a couple questions just to reflect on this trade. I mean, the way that you were sizing, you did share how many shares you bought and sold at various points during these trades. I mean, how were you determining your position sizing?
I mean, in a situation like this, right, it's like when you at LRP and when you're trying to buy a halt, sometimes you don't have an option to choose the size you want because it's what you get. Uh, it's like everyone is trying to buy, so it's how much you can get in that situation. So on those LRPs, it's all about how much you can get. When it comes to the pre-market trade that I did, I I thought that because it's become an $80 stock, I didn't want to be more than 4 or 5,000 shares because if you're wrong, it can go against you very quickly. At the same time, if the imbalance disappears, if someone comes as a big sell and and that auction goes to zero, and there's not a buy imbalance as it was before, then getting out of a big amount of shares could be worth at least 4 or 5 points on the other side. So I wanted to keep in the 5,000 range, because if I'm wrong, then I lose about 2 or 3 points getting out, and that's what I want to be, because I lost the day before in that stock, so I didn't want to again give back more money in that stock.
Another question for you. After the big gap up where it opened, came back online after the halt at 175 or 175, what gave you the confidence to short it there? I know it had gapped up a huge amount, but huge is obviously always a relative term.
Relative, exactly. I mean, I've done this before.
Yeah, but huge is obviously always a relative term.
Relative, exactly. I mean, I've done this before in GME, and I've got screwed in it where it's I was long, it gapped up, and then it again halted up. So basically, when I'm shorting, so I only short at 500 because I'm like on my keyboard ready to get out. I'm like, if this goes against me 2 or 3 points, I'm out, right? So you're supposed to be really quick on it, because the idea is very simple. Like, if it doesn't halt down, you're getting out. There's no other question in my head. I'm like, if this doesn't gap down, I'm getting out. So it's basically I'm already doing a delta up. Like, I'm already like deltaing, maybe delta 2 points up, that in case if I'm wrong, I'm going to get out, whatever happens. So I'm not marketing, but I'm doing a delta order. So let's say the stock is trading at $300 right now. I'm putting an order at 302 to get out.
Okay, so you'll sweep the book up.
I'll sweep the book up if I have to.
Gotcha.
Because I need to get out, because everyone is going to sweep the book. Everyone's going to market order on that, kind of stuff. So it's like you want to be first to it.
Okay. Just to summarize here, and we'll wrap this up in a moment, but what things did you get right here, and what things do you think you could have done better? Obviously, hindsight, as you said, is always 50-50, but just doing a little bit of reflection here, what are some of the things that you're pleased that you did and you feel like you got right, and maybe some of the things you could have fine-tuned a little bit next time?
So one thing I think I got right was the bias part, right? Like, I realized on day one I was biased on the stock. I'm like, this doesn't make sense. This is just, how can a stock like this go up? I'm not in that kind of crowd either, that would buy a stock like that. So in my head, I was like, yeah, this is just something that's going to go up 15-20%, come down. So you have that bias in your head. And second day, I'm like, let me just trade the stock the way it should be traded. Let me just trade it, instead of like thinking, oh, this stock should be valued at this price right now, or that price. I'm a day trader. I'm looking at what's going to happen in the next 10, 15, 20 minutes. I don't care what's going to happen in the next 3 or 4 days, So let me just trade that day, that moment, and see what the stock is doing, instead of me trying to put my bias first. Like, and you learn from, moves like AMC and GME that, when you have a bias, it doesn't work out. We all knew, even the smartest or the dumbest person on the street, that GME is not worth 400 or AMC is not worth 60 or 70 or 80 or 90, wherever it went to. And you can see that today in the stock market when AMC is trading at what, $15, right? Yeah, $18 right now. So you know that, but then you don't want your career to get over before you can short that stock when the time comes, right? So I'm glad that bias part was good, and so let me just trade the stock instead of trading what I think the valuation should be or where the stock should be trading. Let me just trade the stock. What can I do better? I don't know. You can always do more size, but it's easier said than done. I think on that imbalanced trade at the open, I should have taken some more size for sure. Rest, I don't know because I've been burned before by buying halts that are gapped up, and I've been burned shorting halts that have gapped up also. So it's like that's like it just happens so quick, Aaron, that that it's a split of a second decision, and as traders you do make it, and sometimes you get right and sometimes you get wrong. So if it's going to hold down, you just want to be your key, you make the right keys and the right quickness to be there. And then that's where I think I would have an edge over someone else does, because we have the right keys and the right exchanges and things like that to get those LRP prints at times.
When you say the right keys, what do you exactly mean there?
Just like like I'm saying, if I was wrong, I would use a delta key to get out.
Okay.
The same way there are keys that you can make that you can be quicker to get to the LRP. That you can it's tough to get filled at LRP because it's like many people are selling out there too. Because everyone realizes that the stock has gone up crazy and they want to make quick profits, and it was the retail craziness was still going on that time, so there was so much volume and retail trading that was going on. It's a lot of things that goes on, but yeah.
All right, Nish, let's leave it there for now. Once again, or as always, it's awesome to have you on and share your wisdom, so I appreciate you doing this. If someone wants to follow you on Twitter, maybe, would you like to give out your handle?
Yeah, my Twitter handle should be out there, I think. But it's Nishant82. And people always find me somehow on Instagram too. And they find me on Facebook somehow too. And they keep messaging me on how to how do I apply to the company that I work for. Let me tell you guys, I have no way to do that. So just apply to the company directly.
Okay, don't hassle Nishant.
No, you can hassle me. You can ask me questions, but it's tough to really coach someone through text messaging. I feel like that's really hard. I think when you show me a chart of a stock that you've traded, and I can help you with something like that, but they're like, oh, how do I become a better trader? I'm like, I don't know what kind of trader you are in the first place. So it's but I've spoken to a lot of your listeners. A lot of you listeners call me. I've spoken to them. I'm always open to helping people out because that's how I became a trader too. Someone helped me out. So, and it's the best job in the world, especially if you love it.
Yeah, it's very good of you. All right, Nishant, and again, I appreciate you doing this. Once again, it's always a pleasure to speak to you. Until next time.
And I just want to give you kudos because your podcasts are one of the best podcasts. Even as a senior trader, as someone who's traded for 15, 16 years, I still listen to each one of them. And
that's awesome, man.
Yeah, so I suggest that everyone who's young and upcoming, or even a senior trader, should listen to your podcast because I think you learn something from someone always.
Very kind, very kind. Thank you.
Thank you, Aaron.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, friends? Welcome to the show. This year, so far, I have brought you some truly phenomenal traders, and that continues right here on episode 233. My guest is equities trader Kenny Sharkness, although some will know him better simply as Shark. While Kenny himself keeps a low profile online, anyone that follows S&B Capital has likely heard Mike Bellafiore make references to Shark, as he's consistently one of the top performing traders at the firm, which he joined in 2010. Now, the areas we covered during this interview I think will be of most interest to developing traders, those who are early on in their trading journey, but of course there is something for everyone. We cover things like a slow start, gaining consistency, growing P&L, the positives that can follow from a blowout loss, complacency, expanding into additional strategies, and mindset. So there's quite a bit packed in here. As there are references to specific stocks and prices, as well as some talk of preparing for the year ahead, I will point out that this was actually recorded a couple days before Christmas. Now, I know that probably sounds quite odd to hear. I've been sitting on this interview for 4 months, but it's just the way things have worked out with scheduling and ordering, etc. Anyway, I am now pleased to present from New York, Kenny Sharkness on Chat with Traders. If we could start by just going back in time a little bit, back to 2010, I think it was. Why did you want to become a trader?
I guess I wanted to become a trader because it seemed like something I'd like to do, really as straightforward as that. As a finance major, I was looking for kind of the next step, and I always was into strategic games. I played poker, I played a bunch of video games in college, and I got a hold of Market Wizards and some other books, and I was like, wow, this is really something that could be up my alley. And I interviewed at a few brokerage houses, and I realized it was just cold calling and selling and that sort of thing. That just wasn't me. And so then I dug into it a little bit more. I said, okay, I'm going to try this out. Luckily, I had supportive parents that kind of supported me for the first year. I told them, give me a year to figure this out. And, luckily it worked out.
And at that point, had you gone down the route of trying to get yourself on a prop trading desk?
Yeah, I knew nothing at the start. And so I knew I needed to get some training. And so I looked around to places that had programs that taught you how to trade. And SMB was the one that I gravitated to, and went through a few interviews and got the job. And, at the time, it's different now, but we actually had to pay for the training, but then they would onboard you and give you an account to trade. Very small at the time, they give you more risk if you do well, but So I actually paid to start, my first job out of college, which is, I would say, a little bit unusual, but it was also very beneficial because I knew nothing and I just got taught good habits from the get-go, and I didn't have to break any bad habits, and I think I started from a good footprint, basically.
So you hadn't placed any trades prior to joining S&B?
None
Whatsoever.
I didn't even know what a bid ask level 1, level 2, anything really, when I first started.
Let's go through your early experience. So talk to me about that first year. Did you have a natural talent for this? Did you just hit the ground running, or what did it look like?
I mean, it's so long ago now, but I don't think I was some sort of savant or prodigy or any of that. I think what benefited me was having the right attitude from the get-go, knowing that I was going to suck and it was going to take a while, and my focus really was getting better and setting goals and making incremental progress and all the cliche things that really work. So the first year I think I just got my account green after 10 months, but the biggest benefit, and I guess the biggest service I did for myself, was never dig myself a hole trading super small 100-share lots until I really proved to myself that I had some consistency, I had some edge, and then from there on out, it was about just developing that a little bit further and scaling up and that sort of thing.
I think that's probably quite an important point you bring up there. You didn't dig yourself into a hole. So I'd like to just not gloss over that. I mean, how did you go about that? I know you said you just traded very small, but was there, for someone else who's listening to this, who's just coming into trading, they might hear that, okay, don't dig yourself into a hole. I mean, what more to it is there?
Yeah, I mean, keeping your risk limits super small at the beginning is simple as that. Obviously, I'm at a firm and we have our risk limits there, and there's a risk manager, and so it's a little bit different if you're trading on your own, but you can still set yourself risk limits and stick to it and never lose more than just a couple $100 in a day at the beginning. And usually at the beginning, especially when you're not trading well and you're down money, it's not something that you're just going to dig yourself out of. You just kind of take a step back, treat it as a little bit of tuition, and go about the next day trying to get a little bit better. So that was the biggest thing, was just keeping things super small until I had, some sort of little, albeit track record, and then go from there.
Okay. When we spoke beforehand the other week, you said that your progress was very slow. And maybe a little bit too slow. Can you speak to that a little more?
Yeah, it's so funny looking back, because it's definitely not a problem I have these days. But at the beginning, my biggest problem was scaling up. And so I say that because I think I could have been trading bigger, year 2, year 3, year 4, and making a lot more. But at the same time, it was probably beneficial to go incremental, so my psychology was always there. But that was a big thing, and what I did was I set goals to try to trade a little bit bigger, feel a little bit more uncomfortable in my trades, journaled about it, reviewed it each month, and then kind of just chipped away at it. And it seemed slow at the time, but I guess looking back, I'm happy with the progress I've made, I guess.
I know it was 10 or more years ago, but can you recall what some of those goals were?
Sure. I mean, like I just said, maybe I wanted to make sure I felt uncomfortable in my best trades, meaning, I put a little bit more size than I was used to, and, cross the line a little bit where I'd start to feel it. But I always was very good about setting goals. I would have a whole process of, each month I would have a goal, and then I would drill that down to each day, and it would always be something process oriented, not P&L. So like I said, maybe I'm feeling uncomfortable in a trade, or maybe holding my winners a little bit longer with a system and following the system. And then I would grade myself on that stuff each day. At the end of the month, I would kind of see how I did progress wise and decide whether I wanted to kind of shift my next month's goal and my daily goal, and just chip away at things like that. And there's all these books about goals. I forget the whole acronym. You have to be measurable, attainable, blah 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 blah. But you got to set the goal and then set the steps that you're going to do to get towards it. And it's always slow progress, but progress is made over time.
So it almost sounds like you kind of picked one thing each month and then almost like prioritize that.
Yeah, I would say it would maybe be 3 or 4 things for the month, but then it would just be one thing each day. And I thought that doing that, I'd get good, or I'd make improvements, I should say, on the one thing I was really focusing on, and be in my forefront of my brain each day. So I'd really be thinking about it rather than having 10 goals, where I see some people do that and they're trying to work on 10 things at once, but they don't really do it in a disciplined way, or a way that's going to actually improve. They're just spreading themselves too thin. So I think, that was definitely instrumental, doing it the right way, and just making progress 1 or 2 things at a time, and not trying to be a hero.
Can you speak more to the consistency part of this? Like, how did you gain consistency? I know that's probably quite a simple question, or a very broad question, but obviously as for new traders and developing traders, that is kind of like the ultimate thing, right? In the very beginning, is to get consistent. How were you able to develop consistency?
I mean, it really goes back to the same sort of thing. Just review, having a process to get better each day. It's good to be on a desk where you're seeing people that make money and you can emulate them a little bit. So you learn the setups a little bit better, rather than just going at it the way you traded it. Was it the market? Were your stops too tight? Did you not hold your winners? Then through that process, you see the mistakes you're repeating. You kind of attack those a little bit. You see what you do well. You try to scale that up a little bit. And you see what you do good in certain markets and what you do bad in other markets. And all those things, you just make little tweaks until your edge kind of comes into its own. And everyone's going to be different. Some people are going to trade 10-minute time frame. Some people are going to trade 2-week time frame. And I knew that I had to find what kind of worked for me. And that was a little bit more of an active style. And through that style, consistency was really important, because if you're day trading, you really want to try the best you can to pull some money out of the market each day. And obviously, when you're swing trading or you're doing longer term investing, it can be a lot more up and down. So just making those little changes each day, and again, gets back to all this cliche stuff, but that's really what worked at the beginning for me.
What were some of those setups which you first started to trade and you found, that started to work for you?
Oh man, I remember, it's kind of funny looking back. We used to sometimes find charts that were in a 5-cent range for like 30 minutes, and then that 5-cent range would break, and you just play the break, and that actually would work a little bit back in the day. But algorithms have totally eliminated that stuff. But it's just funny thinking back. But I would have a bucket of things, and I would try to just pick up as much as I could from people that are doing well. So whether that be kind of a daily chart breakout, or a stock that was in play and was breaking the opening range, or opening drive setup, where you'd have a stock that is doing a lot of pre-market volume, and you would just get in the first move and try to kind of follow the tape a little bit. When I first started, I did a lot more on tape reading, and then over the years, I think that one has become more difficult with algorithms and other things being more competitive. And 2, I'm just too old for that, and 3, it's just not as scalable. So my style has definitely adapted a ton over the years, but at the beginning, it was a lot more short-term, quick stuff.
Okay. We're absolutely going to get into more of what you're doing nowadays, but just sticking with this point of consistency, the position you're in at the moment, I presume you interact with a lot of the junior traders at the firm, and I'm sure, some of those traders are still trying to find their feet, still trying to find consistency.
Mm-hmm.
Is there any kind of theme or common, stumbling blocks you've observed which sort of hinders their consistency?
Really, everyone has their own thing. Some people go at it too fast. Some people go at it too slow. Some people don't hold winners. Some people, everyone has their own thing and their own obstacles, and they kind of have to attack it their own ways. I've seen it not work out for many a trader for a variety of different reasons. As far as commonalities, I mean, it's just about having a plan, being able to stick to it. Really the psychology aspect, of course, is the most important. And so the ones that can kind of get their psychology under their feet and being able to deal with the ups and downs and still make the next trade the same way, even if the previous trade was a loser, and just really drill down on what triggers them and their psychology are the ones that are going to work out. I don't really have the one thing that I see across everyone that hasn't made it, if that makes sense.
It does, yeah.
That's what I would say there. I think everyone has their own issues, their own demons, and it's about finding them out and attacking them.
Let's get more into growing profitability. So I think you said, that first year, by the end of it, you did manage to be slightly green on the year.
Mm-hmm.
But what was it like after that point? How quickly were you able to ramp up, your daily P&L numbers?
Oh man, it took a while. But every year was a little bit better, and then the numbers, I would pretty much grow seemingly at the similar, kind of make double the previous year for many years. And that was just about making my goals about trading bigger. And like I said, it wasn't really as fast as I wanted things to happen, but I did it in a way that never messed up my psychology. And then really, I think the turning point to really turning it up a little bit was when it was KBIO. I know a lot of people have talked about that one in the past probably, and I took a really big loss on that trade, like 10 times bigger than any other loss I had taken. And then just seeing myself dig out of that within a couple months, I think at that point I was like, man, it's just not that bad. Like if I can deal with that, my risk tolerance grew so much at that point, I think. And then if you go even further, taking some more big losses and coming back, you just build that resiliency over the years, and then you make a little bit of money, and it just becomes a little bit easier to deal with some of the swings.
Okay, so if that KBIO trade was a bit of a pivotal moment, what year was this? This must have been like 2018,
I don't even remember.
17, like it was a while back, right?
Yeah, something like that. Maybe I half erased it from my memory. I don't remember
PTSD.
the year.
What was? How come you took such a big loss on that? 10 times bigger than what you normally would accept.
Well, I did all the cardinal sin things there. I remember it was a bankruptcy stock that was trading like $2.50, and I was short it because the parts were worth 50 cents or something. But it was a low float, and then Martin Shkreli came in, did a reverse merger, and then it started squeezing after hours. And instead of just eating my loss, even though it kind of skipped up $2 before I could get out, I tried to do the add game, and then it went from 2 to 10 to 15 to 20, and I had never seen a squeeze like that. Now there's seemingly one like that every month, but I didn't get out, and I tried to fight my way out of it, and that was the costly error. So when in doubt, get out, and that's the big lesson.
Right. So once this trade was you'd covered, you were out, it was kind of booked. I mean, how did you feel at the time?
Yeah, it was a little traumatic at the time. I remember walking back, just thinking, replaying it, and I definitely felt a little bit down, but I kind of worked it out with the firm over the next few days where they would just cut my split, and as I chipped it away, so that really helped my psychology as well. And instead of getting my normal split, they just pay me out 10%, and the rest would go to the whole. And that was instrumental, I think. And I just got back up, tried to just make a couple green days, get a little confidence, knowing that was kind of a fluke thing, and learn from it. And like I said, we really got into a really volatile time, I think, a couple months later, and I was able to just get out of it real quickly. So at that point, I think I kind of hit a light bulb where, things are not that bad. You lose a little bit of money, it's okay, and there'll be another day.
This might sound like a bit of an odd question, but, do you think if it wasn't for those kind of, taking those big hits, that you might not be the trader you are today?
Yeah, I think that's 100% true. And I think every big trader can probably point to some of those moments. I think I heard once Paul Tudor Jones won't hire people that haven't dealt with a situation like that before, because you just have to have some bumps and bruises to build that resiliency and build that tolerance and that sort of thing. So I 100% believe that if it wasn't for those things that feel like the worst thing ever at the time, but in the end can be very instrumental in long-term success.
Yeah, as devastating it is at the time.
I'm not saying go out and just blow up an account so you can feel it, but but it's kind of inevitable if you're trading long enough.
Of course. What about in terms of any systems or processes you put in place to help build your risk tolerance?
Yeah, I mean, being at a firm, it's a lot more organized. So the way it works is we have a stop loss for the day, and if you hit that number, you at least have to have a conversation. If it's a really special circumstance, you can maybe keep trading, depending on if your mind's in the right spot. But over the years, as you do better and better, and you say, "Oh, I've proven I can make this amount," then they'll increase your stop loss, and that just can go on and on and on. So it's a little bit more organized, I think, when you're at a prop firm than it is, if you're trading on your own. But that's not to say you can't organize it yourself and have your stop loss, then increase it as your account grows, so that you're not risking too much of your account on any day or any trade.
What was the process for increasing your risk each day? Or sorry, as your account grew, I should say.
The process was just chipping away at my size, hitting those goals, having record month, going to the risk manager saying, next month I want to increase my stop by 10% or 15% or whatever it is, and then trying to structure each trade within that. So if your stop is, say, 500, maybe you're risking $50 a trade, and then your stop goes to 1,000, you'll risk $100 a trade and try to trade the same way. As it grows and grows and grows, then maybe your strategies have to adjust because scalability becomes an issue, but very systemized. And as you risk more, you really want to evaluate if you're trading the same way and if it makes sense, and you're not changing your strategy just because you have a little bit more size.
How long was it until you hit your first $1 million year?
How long ago was that? I think it took me maybe 5 or 6 years. I don't remember the exact year, but it definitely took a while.
Okay. And how did that feel at the time? Like, was that also another pivotal moment in your career?
I mean, that was a big goal I had, sure. So it felt good at the time, but as with everything, it's kind of, you hit your goal, you celebrate, you maybe do something to reward yourself, and then you set another one, and it's kind of all about the chase and the process and enjoying it. So yeah, it felt good. I do remember, but it wasn't like some euphoric moment by any means.
Okay.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit. And move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more. All in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I'd be interested to learn a bit more about how you've kind of pushed the boundaries, how you've maximized your edge. You know, up to this point, we've kind of spoken about, you know, your early developments, gaining consistency, sort of growing your profitability, building your risk tolerance. But, you know, how were you able to continue pushing the boundaries? Like, what's enabled you to go from having your first $1 million year to then, you know, doing $5-10 million a year and so forth? Like, are you just doing the same things but bigger? I'm sure it's not as simple as that.
Well, you know, the thing I love about trading is you always pursue the best version of yourself, and you have that pursuit of excellence all the time. And I was always really competitive, so I wanted to be kind of the biggest, best trader at the firm. So that was something that motivated me. And then just trying to see how good I could be is another thing that motivated me. Yeah, so every year I just try to improve, and then as I've gotten, you know, over the years, then your strategies adjust a little bit. So maybe on low floats, you got to be careful about taking too much size, for example. And so now I've started to gravitate a little bit more to bigger cap stocks and doing a little bit more with options and hedging and being able to take overnight risk comfortably. So certainly, you know, my time frame has also probably lengthened quite a bit. So yeah, all those things kind of go into it, I would say.
Okay. I think possibly what I'm trying to get at here is, you know, Mike speaks quite often about breadth. Like, is that relevant to this question here?
I think that's one of my strengths, is I'm able to do a lot of things at once, but I don't think that matters that much, in that certain traders can do really well just trading a couple symbols a day. For me, I would get impatient, and it was just beneficial for me to trade more symbols so that I could, you know, not get too impulsive. And then additionally, if you do have the ability to kind of process a lot of trades at once, you're obviously making more bets. You know, trading is a game of probabilities. You want to be the casino, so the more good bets you can make, you know, the better you should do, the more consistent you should be, and the more money you should make. So that's definitely a strength and goes into it. I don't think it's necessarily pivotal, because I see other traders do great just trading a few names.
Okay. What about specific challenges you've encountered along the way, you know, while scaling? I think, I may be wrong here, but I think when I did a podcast with Mike a little while ago, he made some comment about how, and correct me if I'm wrong here, you know, you were too early often you'd have the issue where you would be, too early shorting. You like to short the front side of a move, but you'd often run into the issues where you were too early. So, like, what did you do to kind of counter those issues? And that's just one example. But like, are there other things? Like, did you? I don't know. I can't even think of something at the moment. But like, not just like P&L, maybe like there was something like psychological that you had to kind of push through.
Yeah, so that's actually that's a good one, because one of the big stumbling blocks in my psychology was just being over eager, and I was always pretty competitive. So if I saw a big trade setting up, then the FOMO would kick in, and you'd be scared of missing it. I'd be scared of missing it, and I might do a little bit of size 1 or 2 days early, and then that would really eat into the trade. And so yeah, I've definitely made a lot of strides on that by really focusing on lowering my stress points in each trade. If I felt stressed or eager, I would really try to be on top of it. Additionally, I use options often if the stock is optionable, where if I'm trading front side, I'll almost never do it without a hedge. And then additionally, if I'm doing like a low float, for example, I'm almost always waiting for the backside now, because it's just not worth it, especially with what we've seen the last couple of years and how far things can go up. It's been pretty amazing. So that was a big thing, thinking about where there was any stress points in my trading and really trying to eliminate that. And I think that's been super instrumental in kind of my success over the last couple of years.
Are there other trades or other strategies which you play where you've also lowered your stress points other than just, shorting parabolic stocks?
I've tried to do that across the board. Lower my variance overnight by using hedges or taking less pieces overnight. That was one thing. Just trying to have winners overnight rather than anticipating or getting in early. Only take winners overnight if I'm not, hedged out or something like that. I think the idea of being early is not just on a parabolic short. It's about any trade that you anticipate. So I try to kind of implement the same thing across the board rather than just on kind of parabolic shorts.
Yeah. Now, you've been trading a little over 10 years now. There's traders who have been doing this as long as you, if not longer. And most, the majority here do not have comparable performance to you. How come? Like, how come you're an outlier?
That's a tough question to answer, but I think I do see a lot of complacency, I would say. You get stuck in a pay the bills mode, and then you just get used to it, and you just go and punch the keys every day without really trying to improve. I think I definitely have a little bit more competitiveness than most, and so that's certainly helped motivate me. I think a mix of being competitive but being humble enough to know when you're wrong and take a step back is a combination that I don't see that often. So that's definitely one thing I think that. But yeah, I see it. I see it across people I train and across the firm where you just get comfortable and one day bleeds into the next, and you're not really pushing the boundaries.
It's interesting because is that ever? So complacency and getting comfortable has never really been an issue with you, because obviously you've made enough money where that could easily be the case.
It hasn't yet. Maybe it will one day. I see some of my friends that were super successful losing a little motivation lately. Hasn't happened to me. I'm not saying it never will. I still love trading, and I want to push myself as much as I can, and I enjoy it. The money's never been a motivating factor. It's kind of just how you keep score in trading. It's been about trying to be the best version of yourself, trying to just trying to be the best out there if possible.
Let's get more into how you are trading today. You spoke right at the beginning, you trade these little 5-cent range breakouts back in the day, but what are the sort of things that you're doing now?
I try to have a lot of different strategies and then pull out which ones are working in the current market. So I definitely do gravitate towards the short side, and those parabolic shorts we mentioned is something that I like. And, the GMEs at 400 or 500, that sort of stuff is my bread and butter, I would say. But I'm doing a lot of different things. For example, now I'm put on some stocks for the January effect, where maybe there's some tax loss selling at the end of the year, and stocks might go up at the beginning of the year, and doing some of those trades. And I do some breakouts from daily charts and pullback trades. And if the market's really volatile, then I'll try to shorten my stroke a little bit and do more scalping around the indexes based on key levels and NYSE tick and that sort of thing. So I try to basically see wherever anyone's making money, and if it makes sense to me, I'll try to implement it into my game with small size. And as I get more comfortable with the setups, I'll try to just ramp those up. And that's how I've been able to kind of add different strategies and pull them out when they're relevant for the current environment.
Did I hear you say NYSE tick? What's that?
That's a common indicator people use of where the amount of stocks upticking at once at the NYSE, I think, is. And then usually people view plus or minus 1,000 as significantly or statistically significant, rather. That's not something I'm necessarily going to trade on, but it's just one indicator I might use while trading the indexes. I don't love trading the indexes, but when the market gets really volatile, even like it has been the last couple of weeks, that's where you got to kind of gravitate towards. And I do see another commonality, going back to your previous question, of people kind of get stuck in one strategy, and then maybe they learn something that works for a little bit, and they're not working on their game outside of that, and that's something that can kind of get people stuck in the mud a little bit.
Yeah, well, let's speak about that, because that's a good point, actually. So say you have developed consistency and you're doing quite well with a particular strategy or a couple strategies in, a niche or an area of the market. How do you start to build your confidence and your ability to trade other strategies?
Yeah, it kind of like what I just mentioned is just doing it small, reaching out to people that are doing other things and learning from them and talking to them and doing it with small size, making a plan, sticking to it, seeing if you can get a little bit of track record under your belt. And then once you see some success, it's a lot easier to scale things up comfortably. And the other key is looking for other things, not getting too comfortable if something's working. And so again, that's an advantage about being at a firm where you're seeing a lot of guys do a lot of different things, and so you can pick up on a lot more rather than just going about it on your own.
And all these things you've mentioned, these various types of strategies and plays, are these all discretionary, or is there some systematic aspect to it?
For the most part. I mean, I run one model. It's not a very large percentage of my P&L. I do have a lot of different filters and things like that are giving me ideas, but for the most part, I would say 85% of, maybe 90% of my trading is discretionary, yeah.
Okay. Could we take a few moments to go through, one or two recent trade examples?
Okay, sure, without giving away too much. So a trade that I'm in now is I'm short some AMC. I oftentimes what I'll do is, as the stock's going up, I'll buy some calls and anticipate it going a little bit higher, so I can kind of work into a short with a built-in stop. So that's kind of what I did with AMC. I bought 32 calls and I was shorting it over the last couple days. and then I'm hoping that it will stop somewhere around here and turn its way down and go towards, eventually its fundamental value of lower than here. So if that, without giving away too much, that's one trade I'm in. Another trade I mentioned is for the January effect, long a little bit of BABA, because I think everyone has sold it out a little bit much, and oftentimes there's tax loss selling at the end of the year, and people buy back those stocks at the beginning of the year. So that's another trade I'm in.
This AMC trade, you're obviously talking about a multi-day kind of swing short here.
Yeah.
Would you be able to go into how you use options a little more? This is something not many traders speak about this too much, especially we haven't really covered it on the podcast too much. You're an equities trader, but you do use options for the purpose of hedging. Can you speak to that a little more? Like, I know this kind of probably plays into one of those issues you highlighted earlier where, you can get crushed by being too early, but options can help to counter that.
Yeah. What I found was that, I would do okay with options just directionally, but, options are like insurance where you don't ever really want, insurance, you pay for it each year, but you don't want something to happen. And over time, option dealers are the ones that really make money, as long as you avoid those crazy outlier events. So yeah, that was the crux of it from the beginning. And then secondly, as you mentioned about being early, that was a big problem of mine. So I use the options to avoid that a little bit. And then I've kind of developed over time a little bit more and more on that strategy where I might, try to be short volatility on some options in certain situations if the implied volatility is really high, or maybe I'll try to be long volatility if I anticipate a range breakout, that sort of thing. But the crux of it is just risk management, where I'm pretty good, I found, at finding turning points within a day or two, and rather than having to be so perfect and picking the exact day. And then additionally waiting for something to break so that you have a clear stop point. With options, I'm able to kind of have built-in stops, and that helps me trade around positions and time things not so perfectly. So usually I can be within a few days. That's where the options really help.
Okay. This might sound like a bit of a silly question, but what's the added benefit of using options as a hedge? Like, so if I understand correctly, in this AMC example, you're shorting the AMC stock, but then you're buying option calls. So you're effectively long the options and short the stock. So you're hedged.
Mm-hmm.
Like, how come you don't just forget about the options and just wait to short the stock at a later point if you think that you're early at the time of putting on a hedge?
Yeah, there's a couple things. The first thing is, if I'm waiting for the stock to break, I'm usually going to be shorting at a lower point anyway. So if I'm trading on the options and I'm doing a little bit on the front side, maybe I'm a little bit early, but I can usually scale into the position and make up the difference in the premium by just having a better price when it turns. And then additionally, I can usually trade around the position and use the wiggles to kind of pay for the hedge and then leave a core on for a kind of a bigger trade. And then finally, the big thing is you can sleep at night, especially as positions get larger. So you always have your worst case scenario covered. And in the end, trading really is just about living to fight another day. So that's been instrumental in lowering my stress and helping me sleep better at night, and scaling up in a more controlled way, basically.
Right, lowering your stress points. So with your hedge, do you typically make money or lose money on that?
Well, the idea is to lose money on the hedge. There are times where each scenario is a little bit different, and you evaluate the risk reward on a trade as the trade develops. So sometimes I'll sell my hedge and go naked short completely. Sometimes I'll sell my hedges and buy another strike up, maybe even double size. Sometimes I'll sell premium against them. So it really is very situation specific. And in the end, that's where my discretion of what I think the next most likely scenario is, and putting myself in the best situation. So that's a hard question to answer specifically. I think, yes, I'm anticipating losing on the hedge most likely.
Okay. Yeah, that makes sense. Now, Mike often speaks about the idea or this concept of being a bionic trader, so using technology to assist your trading.
Mm-hmm.
Is this something you do quite a bit of? Like, are there custom tools that you've built out to help you?
Yeah, I have a million different things that are spinning me information, so that's certainly the case. I just try to get as many inputs as possible, and then I kind of use my discretion to sift through them. So there are some filters that look for patterns. For example, maybe something moves a lot really fast, and then I'll immediately spit that symbol out to me, and then I'll look if there's news, what's the news, and I'll try to process that, and then make a decision. That's one example. I have lists of stocks that are doing unusual volume, and I'll sift through those every day, things that get halted. And then other things, one layer forward of even having models that trade and enter and exit for themselves. Like I said, not a huge percentage for my P&L, but something that could grow and be more important in the future.
Last question here, Kenny. And I think this is quite fitting given the time of the year. As we're about to roll over into 2022, how do you prepare? How do you set yourself up for a great year ahead? What sort of things are you doing around this time?
Yeah, well, number one is recharging. So I'll typically take a vacation around this time, and I'll be going to the beach here for the first time in a couple of years next week. So looking forward to that and spending some of the time there to look over my numbers, see what worked, think about goals for the next year, how am I going to go about trying to hit those goals, making sure they're not too P&L focused because so much is dependent on what the market gives you. And just making sure you're doing the things to not get burnt out, staying motivated, and putting yourself in a good place psychologically.
Do you have any idea what some of those goals may be?
It's funny. I've been kind of thinking about it a little bit, but I haven't really sat down and did a proper, write-up thought. But my goals are certainly shifting at this point in my career where this year, for example, with a new baby, a lot of my goals went away from taking some time away from the screens and spending more time with family and being home for all that stuff. And I actually think that's been really good for my trading because it's just made it less important and made it so that even on a bad day, the next day doesn't bleed in. A bad day doesn't bleed into the next day, rather. As far as, work and goals specific to trading, I haven't really given it too much thought yet. I've kind of had a good year and been trying to just enjoy the end of the year a little bit, and then we'll figure it out here within the next week or two.
I know you said earlier that, especially earlier on, you were kind of like doubling your performance each year pretty consistently. Is that still the case?
No, that's not the case anymore. I think I've hit a point where, and I think most experienced traders hit a point where the market really dictates your P&L, and you can always improve and get better. And then if you had the same market the second time, maybe you do a lot better. But The market's been really good the last couple of years, as so many people have gotten into trading. We had so much volatility with COVID. There's been a lot of stocks that have been flying, providing a lot of opportunities. So there's no guarantee that that's going to continue. So that's why I said it's really hard to. I really try not to set P&L goals anymore, and I really didn't think this year would be as good as it was, but you never really know. So that's why you just try to do your best every day, push yourself, and then things kind of fall into their own.
Just one more thing I'd be curious to know about. How has your mindset and your attitude towards trading evolved as you've had more success? A lot of new traders come in, they're very eager, excitable, that kind of thing. You've been doing this 10 or more years, had vast success. How's your attitude and mindset to trading changed?
Yeah, I think it's just less important now. And I think anyone that trades long enough and has a couple years money in the bank, it just becomes a lot easier to trade and deal with ups and downs and dealing with the slumps. And it still hurts every time, but it hurts for a lot less time. And the next day is a lot easier to not make mistakes when you've been trading for a long time. So, I think through all the ups and downs, you just become a pretty level-headed, I think. And that's always been my MO a little bit as well, is just don't get too high or too low. And that has certainly gotten easier over the years as you just see more and you have more experience.
Okay, Kenny. Well, I appreciate you taking the time to do this. It's been just fantastic to have the opportunity to speak with you. I don't know why we didn't do this sooner.
Yeah, that was great. Thank you.
I know you keep a pretty low profile online. I always ask guests at the end, like, is there anywhere they follow you, find out more about you? I don't know if you have an answer for this.
Yeah, I'm not a big Twitter, Instagram guy. Not big with the social media.
Okay. All right. Well, once again, Kenny, greatly appreciate your time. Thank you very much.
Thanks for having me.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member.
markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
How you doing, traders? Thank you for tuning in here for episode 234. We are about to venture into new territory now. For the first time on CWT, I'm speaking with a trader of prediction markets. If you're oblivious to what a prediction market is, just as I was only a few weeks ago, then I'll try to summarize it like this. So prediction markets are exchange-traded markets created for the purpose of trading contracts on the outcome of unknown future events. The prices of these contracts change as the market deems an event more or less likely to happen over time. If that was a bit confusing, don't worry, it will all make sense very shortly as the conversation gets underway with today's guest, Doma. Yes, that is an online alias. He has, understandably, requested that I keep his identity anonymous. While prediction markets are still very nascent, Doma has been participating in these markets for quite some time and has witnessed firsthand the recent rise in popularity. While political events are his specialty, as you will hear, Doma will also trade many unusual events too. I'll give you an example. The outcome of Britney Spears' conservatorship, and another one, the Suez Canal obstruction. All in all, he currently nets P&L of several $100,000 a year from doing this. Through this episode, we cover the mechanics of how prediction markets function, an outline of Doma's research process and how he garners an information edge, plus making the actual trade, pricing, bet sizing, and structuring positions. Now, just before we jump to the interview, afterwards, Doma sent me an email with a few additional comments. So in our chat, he speaks about his stint trading stocks, and he felt that it perhaps might have come across as being a little more rosy than it actually was. If you are interested, I've included these comments in the show notes. They can be found at chatwithtraders.com/234. Anyway, I thoroughly enjoyed this conversation. It certainly opened my eyes to something new. Hope you like it also. Here is Doma. You were just trading on something. There was an event 15 minutes ago, right?
Well, yes and no. So I was thinking maybe there were going to be exit polls coming out for Pennsylvania, but that didn't happen. So I'm trading right now. There's a Pennsylvania GOP primary race, which is kind of like a proxy race for the future of the Republican Party between like Trumpism and non-Trumpism. And I'm paying attention to that right now.
Okay. And I know that you are quite active on Polymarket, which I understand is one of the kind of crypto prediction markets or crypto exchanges out there.
Yep.
Did you happen to get tangled up in the crypto bloodshed this past week?
No, because most of my currency is dollar denominated like USDC and not the one that crashed.
Okay. Yeah, that's what I wasn't sure about.
Yeah. Yeah.
Oh, man. How lucky.
Yeah, crazy.
So from what I understand, you packed in your 9 to 5 in 2007.
Yeah, it would have been right around May of 2007. So right around now. Yeah.
Okay. So what were you doing once you left?
Well, so I was already sort of betting on the side as well as playing poker. In fact, the last few months of my job, I had 2 phones when I was going into work, and this guy that's been on the job for 2 years, having 2 phones is a little bit weird. So I was already betting on the side pretty heavily. I was playing a lot of poker at night, and I was kind of like, well, it's now or never. Let's try it out. The worst that can happen, I'll get a job in another year or 2.
Okay. So you were playing poker. Was that online or you were going to actual meetups at the casino?
Yeah,
or?
That was like the heyday of online poker. For anyone that remembers it, party poker. It was called like the moneymaker effect. Like all these people signed up for online poker. The government hadn't cracked down on it yet. And so it was pretty easy games. If you knew some math and you were willing to take a little bit of risk, it wasn't too hard to beat poker at that point.
Okay. So what kind of success did you have with that early on?
Well, earliest on, I lost $100 almost immediately. I deposited $100 that my grandma had given me for graduation, and within like an hour, it was gone. But I had kind of seen how it worked, and I thought I could beat it. So I deposited another $100, and I ran that into a couple thousand within a couple weeks. I wasn't playing high stakes. I was a recent college graduate at that point, so.
Right. Okay. And then I believe that kind of evolved into other things soon after, like.
Yeah. So my first like real bet on like a prediction market type bet was on a sports book. And I bet on the movie Crash to win Best Picture, which was a big upset over Brokeback Mountain. I think it was like 7-1 odds. And I put like $10 on it, and I won $70, and I thought I was a genius. I thought I was rich. And that kind of, kicked it all off.
And was that a bet you placed? That wouldn't have been a prediction market as such, would it? It would have just been with a like a bookie.
Yeah, exactly.
Okay. And so why did you make that bet? Was it just because it had a 7-1 payout?
Yeah, I think I had read Roger Ebert say that he liked that film, and so I was like, well, 7-1, worth a shot.
Okay.
And then so after I won that, I started researching this a little more. I was like, well, this is fun. I don't have to bet on, sports necessarily. And then I found a site called InTrade, which is now defunct, but that was like the first kind of prediction market. And then I started to delve into politics as well as movies.
Okay. So you started betting on politics. And I think you also traded stocks at one point too.
Yeah. So as I said, InTrade went defunct. That was like right after the 2012 election. And so InTrade pulled out of the US, and I was kind of at a decision tree. Do I move out of the US to continue this career, or do I try something else? And I gave stocks a go, and I kind of applied the same principles that I was using in betting to stocks at that point.
And how did that work out for you?
It worked out pretty well. So I took like 35,000, which I thought was like a decent amount of money. Bear in mind, I'm trading my own funds. So I took 35,000, which I thought was a decent chunk. And then I ran it up to like 200,000 or so within a year. So, I mean, I felt pretty good about myself, but I also was kind of still jonesing to do prediction markets again, because stocks are a little bit too unpredictable to me. Like, you can be correct on a stock and the stock still goes down a little bit, whereas that's not really the case in prediction markets.
35,000 to 200 grand in a year or so. I mean, that's really impressive. Was that like, a couple big trades that you made most of that money, or was it kind of consistently being right?
So I was doing a lot of research on shorted stocks and trying to get leverage on a crowded trade that was wrong on the short side. So in other words, if a bunch of people are in a short and they're wrong for whatever reason, the stock can go up pretty quickly. And so you could bet on it with both options and then holding the equity as well.
Okay. So you were trying to anticipate short squeezes, basically.
Yeah. I mean, I was kind of looking for people that had shorted stocks for the wrong reason, basically.
Do you recall what any of those crowded shorts were?
One of them was SAFM, which I'm not sure if it still exists, but it was it's a chicken company. And I had just done a bunch of research. Chicken companies are very simple. It's like inputs, which is like corn and like soybeans, and then output. So it was very straightforward what their business was. And you can kind of research all the inputs and research the outputs and figure out that the shorts didn't quite have it right on why they were shorting it.
This is really interesting because, I mean, anyone else who had a $35,000 account, run it up to 200K, I mean, would most people be pretty happy with that and feel like that they were kind of onto something there. But for you, it sounds like you weren't so convinced. You were more like, you would rather be in the prediction markets?
Yeah, it's just it's really what I love to do, because a prediction market is different than like an equity in a stock. A prediction market is 0 to 100. Either it's yes or no, and then it's usually time based, and then almost certainly it will expire based on, you know, the correct expiration of whatever the event was.
Yeah, okay, that's interesting. So, I mean, how would you make a case? Actually, let's save that, and we should probably talk more about what prediction markets actually are, because I mean, this is only something that's sort of come across my desk recently, and I'm sure for many people listening, this is probably going to be the first time they're hearing about it, or at least hearing a bit more about it beyond the surface. So let me just ask you straight out, what are prediction markets? Like, imagine someone's never heard of it.
Yeah. So it would basically be asking quote unquote important questions that were in the news. So for instance, right now, everybody is interested, is there going to be a recession? So the market could say, by the end of 2022, is the US going to experience a recession, which would be 2 negative GDP quarters? And then I think right now that's at, you know, like 30 cents or something like that. So you could either buy yes for 30 cents and you would get a 70-cent payoff, or you could bet the other way. You could say, well, I think this is unlikely, and that would cost you 70 cents, and your potential profit would be 30 cents.
Okay. And when you place this bet for 30 cents, what are you buying? Like, you're not buying a stock, or you're not buying a futures contract or an option.
Right.
Like, what do you call that?
Right. So, well, I mean, you could call it a number of things. I would call it probably a contract. Prediction markets are zero sum. So you're almost always betting against somebody else who thinks the exact opposite of you. So whenever I buy, let's say, one share at 30 cents, you're consequently buying one share at 70 cents. So our shares are always going to match. So there's always going to be somebody that has the exact opposite view as me somewhere else.
Right. So that's kind of the key thing with these prediction markets, right? Is that the counterpart to your trade or your bet is another trader. It's not, you're not trading against a bookmaker.
Exactly. So it's mano a mano.
Okay. And who are the participants that are mostly involved in these markets? Like, is it just a lot of, individual punters, or are these markets starting to attract, some more kind of professional outfits?
I think it's still so nascent that it's mostly just individuals, and it's usually people that come from a similar background as me, which would be finance or poker or sports betting, or, things along those lines. People that are interested in politics, people that are interested in predicting, economic outcomes, things along those lines.
And would you say that the average participant is like quite savvy, like they're quite, that they research their bets quite well? Like, obviously you are kind of an extreme case of this. But like, if you look at, like, obviously sports betting is a huge thing here in Australia, and a lot of the people who participate in that, I don't want to sound like a dickhead here, but, a lot of them are just purely punters. Like, they'll bet on their favorite football team or something or other. Would you say that there's a lot of unsophisticated participants in these markets, or most of them are quite savvy?
I would say it depends entirely on the type of market. So if you look at, for instance, the presidential elections, those will attract so many types of bettors, people that really know what's going on, people that just want to bet on the person that they like. And then you can compare that to something that's like super granular, like, will this bill pass Congress by June? And you're really up against people that know Congress pretty well.
Okay. Yeah, that's interesting. So with that being said, do you have kind of a preference for which one you'd rather, which prediction or which event you would rather be involved with, or you're not too concerned?
I mean, not really. I do enjoy the bigger markets just because you can bet more. You're against more casual people. The market will probably move a little bit slower to new information, whereas a very granular market with people that really know what's going on. If there's a new piece of information, the market will react very quickly to that.
Mm. And when you say the market will react quickly to that, what does that mean? Like I guess what I'm trying to ask you here is, how does the price change over time?
Right. So let me think of a market. So for instance, there was recently a market latter half of last year on who Biden would pick to be Fed chair. And it was, is he going to renominate Jerome Powell, or is he going to go in a different direction, perhaps a more liberal direction with, I think her name was Lael Brainerd, or is it going to be some, dark horse candidate? And, you're following along, you the prices are what they are. And then let's say the Wall Street Journal reporter is like, well, I've heard, Lael Brainerd is kind of down a little bit. Well, then all of a sudden, Jerome Powell will probably move up, let's say 10 cents. And so that'll happen very quickly. Whereas if it's like a bigger market, like let's say Biden versus Trump in 2020, if a new piece of information comes across, the wire, the market would be so dense and so deep and so many people would be betting it that a 10-cent move may take a few hours.
So when these events, am I using the right term there? Event?
Yeah, events. Yeah.
Okay.
Yeah. Or I mean questions. Yeah. Events. Yeah.
Yeah. Right. So when an event or a question is actually, one of these exchanges actually lists it initially, how is it priced? Like, does it come on at 50 cents?
So the order book is usually initially empty, and people will find the price pretty quickly. And so that's one aspect of a prediction market is, if you get in very early. And so that's one aspect of a prediction market is, if you get in very early, you can end up getting a good price because people are still trying to figure out what this is worth.
Of course. Okay. So it's just like basically how a stock would IPO.
A little bit. Yeah. Yeah. I mean, the IPO would be, more range bound, but yeah.
Are you looking to get involved at those early stages, or do you kind of wait to see how it trades?
I mean, yeah, if it's something that I already know a lot about, then I'm eager to get involved as soon as possible. Yeah.
Now, I want to just hone in a little bit on the time aspect. So, is there always an expiry or an end date to all of these contracts or these events?
Almost always, unless, somebody like, for instance, who is going to be the next Fed chair, I don't think that had an expiration date just because, somebody was going to be picked eventually. So I would say 95% of them have an end date. 5% of them are kind of open-ended, but it's usually something that is going to happen anyway.
And what happens at the end, like when these expire?
Well, so almost always it'll happen before the end date. Usually if you reach the end date, so for instance, will this bill pass by July 31st? If you reach July 31st and it hasn't passed, then it's probably going to expire as no. So as you get closer to July 31st and this bill hasn't passed yet, it's going to drift towards zero.
I noticed on Kalshi, which I believe is one of the exchanges you're active on, there's some pretty obscure kind of events you can bet on. And one of those was something to the extent of, will NASA land a man on the moon by 2025? So with some of these kind of long dated events, I presume that, first of all, I don't even know if that would be something that you'd participate in, that's something that far out. But if it was, is your kind of approach to how you'd trade these to hold to expiry, or are you looking to sell out sooner if price starts to move in your favor enough?
Right. So I think if I were trading that, and I think it's actually very unlikely because NASA has kind of punted that. But let's say it was still up in the air, and let's say it was like a 20% chance in my mind, and so I would be looking at buying below 20 cents. And if new news came in that took me above 20 or took me below 20, then I would trade based on that. But I wouldn't just trade just to trade. So I would kind of have a price of what it's worth in my mind. And then if the price on the exchange moved, then I would trade, based upon my own price, if that makes sense.
So, I mean, I wasn't specifically asking you about this NASA event, but just like for some of these ones where the outcome of the event is like a couple years down the road.
Right. I wouldn't be afraid to bet on that if I thought I had an edge.
Okay.
Yeah.
But you wouldn't necessarily be trying to hold it for the next few years.
I mean, it just depends. I would have a set price of what it is worth, and then if it fluctuated off of that, then I would trade.
Okay, cool. Now, can you just speak a bit about what venues you actually trade on? Like, where can you bet on prediction markets?
Yeah, so the big one that has kind of come to the fore a little bit is Kalshi, as you mentioned. For the U.S. people, there's also Predictit, which is focused solely on politics. There's Polymarket, which is a crypto-based site. And then I also do like kind of side bets with people on Twitter and stuff like that.
Okay. How does that work?
I mean, you find people that you mutually trust. And if you don't mutually trust them, then you find somebody that, can hold the money for you. And then you bet on stuff. So I had a pretty big bet with some like random high profile Twitter lawyer on the 2020 election, and some bookie in Las Vegas held the money for us.
That's fascinating. I didn't know that was a thing.
Oh yeah. It's a big thing. Yeah.
It's a big thing. Okay. So how come you trade on these three to have different, the idea there?
Right. So Kalshi just launched. So it's kind of like a new site, and they're trying to grow. And in fact, they got regulatory approval from the US. So, if I had to anticipate what I'd be doing like 3 years from now, it's probably 75% trading on Kalshi. So the sites have kind of come on as it's becoming, the gray area of legality is kind of fading away a little bit. The US is embracing, prediction markets a bit more than they have in the past. And so I just, the sites come online as they're able to.
Okay. And so you've got these sites like Predictit, and I had a quick look at the website. I think it's mostly a politics thing, right?
It's all politics, yeah.
Does Kalshi or Polymarket, do they do any politics-based events?
Kalshi cannot do elections right now, so they can't do like who's going to win the 2024 race yet. I think they've talked about trying to integrate that into the site eventually, but they can do like political tangential stuff, like who's going to be the next Supreme Court nominee, which was a big market, who's going to be the next Fed chair, as I mentioned, so that they can do stuff that's like, adjacent to politics.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading, Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit, and move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more, all in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and a member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So as you're kind of like an OG in these markets, you've been around a long time doing this. What have you seen? Like, what have you witnessed in the way of market growth, like levels of participation? Has it kind of exploded in recent years, or it's just sort of gradually ticking up? Like, what have you observed there?
Yeah, so I would say generally speaking in the US, betting has become much more popular because I think the Supreme Court knocked it down a few years ago. And so state by state, it's expanding. So along with that, prediction markets have kind of grown and grown because people are more accustomed to betting on stuff within the US, that is. So yeah, I mean, it's a growing space for sure.
Okay, so it's been noticeable for you.
Yeah, for sure. Yeah.
Yeah. I wonder if it's a bit like kind of how the 2020 like market crash and coronavirus and all that. There was a big market crash and coronavirus and all that. There was a big uptick in retail participation in markets. I wonder if it's kind of like similar sort of effect in your markets there.
Yeah, I think so. Yeah.
And what has that meant? What has that meant for you? Like I know like us as equity traders, like there was, some of the moves were obviously a lot more irrational. Stocks would run further than you thought they should. And like, what is this, the greater levels of participation? What's that meant for you? Like, have you had the ability to place larger bets because of this, or have more markets come up? Like, what's been the knock-on effect for you personally?
Yeah, I would say all of the above. The simple answer is that liquidity has increased. And, that's a constant challenge with somebody who does markets for a living is there enough liquidity in order for me to make enough money? And, it has increased steadily. And yes, I do remember seeing a bump in 2020. And also, the US government sent out pretty large checks to almost everyone in America. So you saw bumps along with that as well.
Perhaps a question I should have asked you a little bit earlier, but I'd like to start getting into more about your actual research process and more kind of specifics around your strategy. But just before we do, when I'd spoken to you beforehand, you said something that was quite interesting, and it was like, for many years, this was kind of like you would collect a decent income from doing so, but there was kind of a point, or in more recent years, you've really leveled up. It's gone from being a decent income to, a serious income. What's kind of powered that transition?
I would just, get back to what we just said, which is the popularity of prediction markets has increased because betting in general in the US has become more accepted, I guess. And so people are not as averse to joining sites like this and putting a little bit of money down and trying to predict stuff. So yeah, I would say around 2020, early 2020, my income really leveled up. Yeah.
Okay, so you didn't really change anything you were doing so much. It was more just there was the capacity to do more size.
I do think I have changed a little bit. One thing that I've noticed is that my win rates are really high. And in fact, I was looking at it and I think they're too high. And the reason I say that is because
I've never heard someone say that before.
Well, but they are, because, that means I'm not taking enough risks is what that was telling me, because I should be losing a little bit more and I should be winning a lot more. Do you see what I'm saying?
Okay. Yeah, I know what you're saying.
Yeah, exactly. So I think I had a little bit of a philosophical shift where I was not quite as cautious as I used to be, because if I saw profits in a market, I was like, oh, okay, yeah, let's just take some money off the table here. Whereas now, I have a much larger bankroll and I'm like, well, I think the odds are in my favor. Let's just let it ride on this thing.
Yeah, so just in case anyone listening didn't quite understand why you think your win rate's too high, let me just try and break that down. So, when you look at trend following traders, I think some of them, like a good win rate can be 30%. And that's because, they have few winners. But when they do win, they win really big. And if you look at someone like a scalper, they generally have a high win rate because they take profits so quickly and try to lose as less as possible. So that's basically what you're getting at there, isn't it? Like you weren't allowing profitable bets to really run to their full potential.
Yeah, exactly. Yeah.
Okay, we're gonna dissect this a little bit. So how do you decide what markets and predictions to bet on?
Well, I mean, that's the great thing about prediction markets is you get to decide. Like you can sift through the markets, you can research it before you ever place a bet, and you can figure out if the pricing is wrong or the pricing is right. My best friend is people that think efficient market hypothesis is a real thing. So a lot of people look at these markets and they're like, okay, it's at 60 cents. It must be worth 60 cents. Whereas my whole philosophy is it's at 60 cents. This is probably wrong. Which direction is it wrong in?
So if you pull up one of these exchanges, there's like, I don't know, hundreds, maybe thousands of different events that you can trade on. Like where do you even begin though? Like how do you start to filter through? Obviously you can't research all of them. I mean, I guess it's like, a stock trader or, there's thousands of different stocks they could trade. How do they filter down which ones they're going to actually put money on? Yeah. What's your kind of filtering process?
Right. So I would probably first filter it by, where I have a baseline of knowledge. So in politics or in movies. So I would probably first be drawn to where I already have expertise. The second thing that I would be drawn to is, liquidity. How popular is this market? Let me give you an example. There was that ship stuck in the Suez Canal. When was it? Like March of 2021. And it kind of like fascinated the world. It was like the top news story. It brought global trade to a halt. And there was a prediction market on when it would be dislodged, and everybody was predicting it because it was in the news and it was kind of unpredictable and it was fun, and so I had no knowledge of ships, but I was trading that quite a lot, and I was trying to research ships as much as possible. I was like listening to this Dutch sea captain trying to translate Dutch to English, and so you're doing all these things that you have no knowledge of 2 days earlier to try and trade a market that has, a lot of liquidity and may have people that know less than you do.
Okay, so can you talk me through that bet a little bit more? Like what was your actual bet? Like the ship would be freed by a particular date or?
Right, exactly. Yeah, so I mean, this is over a year ago now, so I'm not sure I'm going to remember the exact contours of it, but let's say it was, will the ship be freed by March 31st? And then from there, you can kind of research, do people that know a lot about shipping think it's going to be free by March 31st? And that's a simple question with, very complex answers and varying opinions. And, there's going to be news articles from all over the world, possibly some in languages you can't read. What do the Egyptians think? What does the company that owns the ship think? So there's all sorts of angles that you can attack this bet from to try and figure out to try to approximate what the correct answer is going to be.
Yeah, it sounds like a tricky one because, I mean, one of the things which just sort of pops into my head is you'd want to look up, previous examples of this. Has anything like this happened before? But I'm not sure if many ships have been stuck there previously. How did that bet play out for you? Did you get it right in the end?
I did get it right. Although what I remember most about that bet is I went away from my computer for like 30 minutes and it randomly got freed like instantly. So I cost myself a couple $1,000 for that. But yeah, I more or less got it mostly correct.
Okay. So why did that cost you a couple $1,000 just because you walked away for a few minutes? Like what did you miss in that time? What happened to the market?
Yeah, so it unexpectedly got freed, I think. I don't think they were, I think they were doing some random stuff. They were like, oh, let's give it a try. And all of a sudden it just kind of dislodged. So it was not very expected. And I think the market which was at, let's say, 35 cents, all of a sudden went to 100 cents. So the market flipped, as we call it.
How did you get out of that bet? Did you just, I mean, you could have still sold it later, right? Like what did you miss in that 30 minutes is kind of what I'm trying to understand.
Right. So what I cost myself is the opportunity to buy it at 35 cents or 36 or 37 as it was being freed and as the market very
more odd than that.
Oh gosh. Yeah, I mean it totally runs the gamut. I would probably need to look that up and get back to this question.
Okay. So just back to the filtering question. What are some of the important factors? So you said that things which you maybe have a baseline of knowledge on,
right.
Although you do still float around a lot. What other kind of important factors or considerations are there? Like, is liquidity, I presume, is a big one. Is there anything else?
Yeah, I would say, general interest level in this event. So it could be something like the ship that I know nothing about, but other people are interested in it. Well, all of a sudden, I need to learn a lot about this because people are going to be trading it. So I would say interest level of other people, liquidity, and then my own baseline of expertise. Because if you think about a prediction market, I was saying it's mono on mono before. So let's say it's me against you, and we're trading on, let's say, something in Australia. Well, I would not be as apt to trade on that because you probably know a lot more about that. Whereas if it was something in the US, I would be much more apt to trade on it, knowing that the other person probably is at a disadvantage. Do you see what I'm saying?
I do.
Yeah.
Although with that being said, I know, you do bet on things you don't have much knowledge on. That's fair to say, right? Like, I presume probably most of your bets are things which you have some sort of baseline knowledge, but you do also vary outside of that as well, right?
Yeah, that's true. Yeah.
So in those cases, I mean, how do you become an expert on those topics in a short period of time? Like, what's your research process? I don't know, maybe if you can think of a recent example might be helpful, but.
Yeah, so a big market right now is whether Finland and Sweden will join NATO by the end of the year. And, that involves so many moving pieces. It involves 30 foreign governments. It involves, Sweden, Finland. And I have no knowledge of this. I'm not a diplomat. But you start reading articles, and then you start picking up names and you start Googling names. So you just kind of start with a very baseline point of knowledge and you try to branch out as quickly as possible. And then you also have to realize on a market like this, the people you're trading against, they won't know the answer either. So you're kind of trying to spread your knowledge as far and wide as possible quicker than these people are. And you're trying to come up with what you think the correct answer is before they can kind of figure it out.
What are some of the most extreme measures you've taken to acquire information?
I mean, I have volunteered for a campaign. Before. Let's see. I was betting on like Croatian elections, and I was watching Croatian TV, and I would take my phone and like use the Google Translate, like real-time pictures, and like hold it up to the TV and kind of try and translate what the chyron said at the bottom of the screen, like just trying to figure it out as quickly as possible. Basically anything I can do within reason that would get me an edge.
With things like politics, that's a subject where people have very strong personal opinions, and I'm sure you probably have your own opinions on the subject. Is it difficult for you to ever remain objective?
I would say it has become
to ever remain objective.
I would say it has become a lot less difficult. When I first started, my own bias has creeped into my betting quite a lot. But, if you let your own biases creep into your betting, you're going to go busto. Creep into your betting, you're going to go busto pretty quickly. So you have to kind of create, a Chinese wall between those two areas of your brain.
A Chinese wall. I like that analogy. A couple questions around the pricing.
Okay.
So a bit of a broad question, but we'll see where it goes. How do you determine what's a good price? Like, do you use some sort of model, or, if you see that a market is the yes side of the contract is currently trading at about 30 cents, but you think fair value is maybe closer to 50, how do you think through that part?
Yeah, so I would say that's the toughest part of the job, is figuring out what the correct price is. And I almost always try and figure out, I call it the true price, like what the true price is. There's the market price, which is the price that's available to you. And then in my head, I try and figure out the true price. I would say it depends heavily on the type of market. And then it also depends on, how finite of a grasp you can get on it. So for instance, if it's something that's a bit unknowable, I may have my odds at 30 cents, but, there's some 20-cent leeway in there. In other words, it's worth anywhere from 10 cents to 50 cents. I think maybe 30 cents is a midpoint. Whereas if it's something that I'm very familiar with and that repeats quite often, like let's say an election, I would probably have a much firmer grasp on the price point. I could say, okay, this is 35 cents plus or minus 5 cents in my mind.
Do you ever have the situation where it might be like 80% of people, so it's 80 cents for the no side of the contract, 20 cents for the yes side? In a situation like that where 80% of the market is saying, no, this event is not going to happen, but you think it does. You think you're more on the yes camp. What gives you the confidence to think the majority are wrong?
Experience. And also, I'm not really afraid to be wrong. Some of my best bets have been absolutely stupid. It's like, because if you're betting on a long shot, nobody thinks it's going to happen. And even a part of you is like, this is a really dumb bet. But, if it's a 5 cent bet, which pays off at almost 20 to 1, it only needs to happen it only needs to happen once out of every 19 times to be profitable,
If you are wrong on a trade once and it over time it comes down to 10 cents, are you saying, well, I'm down 20 cents on this contract or this event, I'm wrong, I'm going to sell it? Or do you just continue to hold through?
Right. So
did that make sense?
No, it made sense. I think in your example, if I haven't sold it yet, then I'm thinking, even though it has declined, I would still be ahead of the market price. So for instance, let's say it's at 30 cents, and in my mind, it's worth 40 cents. And then it decreases to 10 cents, and I'm still holding it. Well, in my mind, it's probably worth at least 10 cents. If I don't think it's worth 10 cents, I'm not afraid to take the loss and dump it.
Okay. So sometimes you will let the market override your kind of research and initial conviction on the trade.
Yeah. I'm not perfect. I'm not, a super genius. And I think, one important thing is to always kind of stay humble and not think of yourself as smarter than everyone else.
Can you speak a little bit on how you size your bets?
Yeah, so I size my bets almost exclusively related to what I think my edge would be. So I'm not sure if you're familiar with it, but there's something called the Kelly criterion. Mm-hmm. Have you heard of this?
Yes.
Yeah. So basically, if I think my edge is high, then I'll bet a lot of money. If I think my edge is low, then I won't bet that much money. And then I always kind of keep in mind, what my rough bankroll is, and I try and size it accordingly.
So is it strictly Kelly criterion, or is it some sort of variant of it?
Well, that's kind of like the philosophy of how I think. I don't necessarily try and be granular with like full Kelly or half Kelly or quarter Kelly, because I know there are a lot of people that kind of try and get very specific with it. I would say that's more just like a philosophy of how I think about betting, which is just, if I think
Use that example.
expects 50 basis points, and I think there's a 50 basis points, and I think there's a 5% chance that'll either be 25 or 75. Well, if 75 is trading at 1% or 25 is trading at 1%, then I'd probably be willing to bet on that, just because I think, well, it's extremely unlikely to happen, but the odds are probably 2%, not 1%. So to answer your question, to get back to your question, I wouldn't be afraid to be betting on both sides. So for instance, I would say, okay, this is extremely likely to be 50, but I'm willing to bet both on 25 and on 75. So I'll structure my bets, around what I think has an edge. To use a different example that I just bet on, the CPI inflation print in the US just came out, I think, last Wednesday. And I had structured my bet to where I think the consensus was 0.2, and I thought 0.2 was priced too high. I'd researched it quite a bit. And I had structured the bet to where I would make a little bit if it was 0.2, I would make a little bit more if it was 0.3, and I would make a lot if it was 0.4. And it ended up being, 0.33, which rounded down to 0.3, which was really close to 0.4. So I just narrowly missed the big win. But yeah, so I had structured the bet to where I'd kind of created bands for myself so that the outcome would be what I was trying to bet on.
Gotcha. Yeah. Yeah, that's really cool. How many trades do you place over? Yeah, how many trades like you?
Yeah.
Right. Okay.
Yeah.
Yeah, how many trades like you?
Yeah.
Right. Okay.
Yeah, so it's not just, so it's not just, I'm betting on quite a lot of markets all at once. So something could change about 5 different markets today, and I'm trading each of those 5 markets based on that new information in each of them.
And let's just say, one of those markets, or do you normally just, one event is one trade?
Yeah, it depends. Oftentimes I'll trade in and out. Sometimes and growing my position. Sometimes I already have a big position and I'm trying to draw it down. So it just depends. But yeah, I'm doing all sorts of things.
Okay.
Sometimes I already have a big position and I'm trying to draw it down. So it just depends. But yeah, I'm doing all sorts of things.
Okay. Now, just before we close us out here, I don't know if you've had a chance to think of one of the strangest events that you've bet on.
Yeah. So the one that I remember is whether Britney Spears would be let out of her conservatorship or not.
Right.
Yeah. And that ended up being like a really big deal in the media. A lot of people were following the trial and stuff like that. And so I really, really, really delved into it. In fact, I was kind of annoying my wife because I was watching like Britney Spears probably like the top ones departed. But at the time that I was making the bet, I knew every in and out of that case and the law. And I ended up making a lot of money on that one.
Do you have any idea like how many hours of research you would have put into?
Yeah, that's a good question. Probably around 100.
Okay.
100, maybe 200. Yeah.
Okay. Are you comfortable talking about how much you made on that trade?
I think around $10,000. So I'm not sure how many hours I spent. I'm not sure if that quite was worth it. But I think there's another element to it.
That's awesome. Words of wisdom here. For any, what are some less experience fall into?
Ooh, okay. I mean, understanding sizing and betting too much on something you're not too familiar with. So I think if you're new to this and let's say you put $100 into it, I would focus on trying to find 10 markets where you think you have an edge and bet $10 on each of them, just as an example. So you can kind of test out your theories without blew $100 within an hour. So you want to make sure that you kind of get the full experience and figure out if you just join and you blow $100 on something and then you quit, actually very good at it and you got unlucky, so it's you have to disentangle luck from skill, and you have to.
Brilliant. All right, Doma, I'm going to let you go and enjoy your evening. I want to say I've really enjoyed this conversation. I'm going to have a closer look at prediction markets myself, just to have a little dig.
Yeah, they're a lot of fun.
So, greatly appreciate you coming on and sharing your wisdom with us. If someone wants to find out more about you and find you online, I think you're on Twitter. I'm not sure if you're anywhere else.
Outrageous. Doma.
Cool. All right, man. Well, I will pop that in the show. Notes, so anyone can find that and a few other links for
Hype on the way soon. So to stay
show notes, so anyone can find that and a few other links for
hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time. Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Made trading seamless and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
I'm glad you're here because today I bring you a man who's truly seen it all, Chris Caddy. Having surpassed 40 years as an equity index trader, Chris has lived through pretty much every type of market environment imaginable. But is experience all it's hyped up to be? Well, that is the opening line for our chat. From there, I get Chris to open up about some of the best times as a trader on the exchange floor. Chris also tells a captivating story about the Hunt brothers when they cornered the silver market in 1980. Then, the later what he calls structure and process, and predominantly trading a style of mean reversion. Chris drops some absolutely fantastic to listen carefully. He also makes reference to various things like software, books, events, etc. Check the show notes. It's all there. All there should you wish to explore further. Chat with Trade. And now, from NY, I present to you Chris. When speaking to someone who's been in the game 40 years like yourself, it seems obvious to ask about, their experience. But one of the things which kind of struck me when we had our quick preliminary is you made some comments which almost made it seem like experience is overrated to a certain degree. Why do you believe experience is perhaps slightly less important than what most people perceive it to be?
I think experience comes too late in the game and at the cost of usually some trauma associated with the obviously negative experience. I mean, there is the understanding of deja vu, and it does happen in trading, or as Mark Twain would say, things do rhyme. Exactly. Not so there is the gut feel, which comes with experience, but I don't think you should necessarily use experience as your only metric in regards to taking advice or finding a teacher, because, as I say, it usually comes after the game is changing, and it comes after the fact in a changing game. So I would suggest that if you're looking for a teacher, to find one that is mentally flexible and also offers a way to get for your own self an emotional handle on your emotions quickly, so that they don't hamstring you when things get crazy or volatile.
Yeah, it seems like when you said this during our chat the other day, that it was largely because of how markets can change so quickly. And I also recall you were saying, I think the first thing you said to me when we got on the phone was, the market is a joke, and you were getting a little bit fired up about it. The market is a joke, and you were getting a little bit fired up about it. So, I mean, let me ask you this, like, after all these years, what surprises you about the current market environment?
To let people know who have never came from an exchange floor environment, there was something called professional courtesy. It allowed you to exit trades usually without too much damage if you were wrong, because there was always the understanding that prices were distributing around what was perceived as fair value. Fair value was not moving that quickly. So there was a much more courtesy or professional courtesy environment, because the center of fair value, what was perceived as fair value, wasn't moving very quickly. Now, in this modern world where information is distributed very quickly, the ladders give the illusion of liquidity, but there's really no resting bid or offer. So that if there's some sort of dislocation in inventory, in other words, there's someone needs something. Ever since just-in-time inventory occurred in the late 90s with Amazon and the beginning of the internet revolution, we've switched to a just-in-time inventory, and that includes the markets as well. So when you have something that needs to go or something that needs to be bought, it takes time to find the other side of the trade once it becomes apparent to the screen. And because of such just-in-time inventory and the execution of people need something, or out it goes, no matter what the cost or the loss. There is no horizontal distribution. Things are moving vertically. As I said, it takes time to find the other side to the trade. So that sort of change has required that A, we become much more mentally flexible. B, you can't average because there's no. And so there is no place for courtesy in that environment. And so it seems, as the people who are listening have been participating, it seems as though those boundaries of rationality in regards to what is perceived as a normal market movement have been stretched to levels that none of us have ever seen. And so, to your point about experience,
it's interesting that you use the word curiosity. Not curiosity, courtesy, professional courtesy, because all the stories you hear about from trading on the floor, they're all very cutthroat. It was a very ruthless environment.
Oh no! The guys on the floor, as a general rule, I was on the floor for 40 years. 30 years, and most of them were very much stand up, and there was a mob rule that effectively created its own rules and its own ethics. In fact, the regulators used to come down to the exchange and ask us, what we were doing, and then they would write the rules around what we were doing, because the game was evolving so quickly, right? From open outcry to a blended technological and open outcry screen-based world. So professional courtesy was something that allowed you to participate on the floor as part of a group that was ruled by the group. And so if you were a competitive or an asshole or somebody who was shady, the group would look the other way when there were good orders. And you knew, right? You knew on the floor when there was a good order. And so professional courtesy was never really talked about, but existed for many, many, many generations.
When you say a good order, what would be an example of that? You mean like someone who's like an uninformed order, someone who hasn't adjusted their quote?
Lord, you saw people. I mean, we would meet people in a bar, and they'd be like, "You're on the floor. You see stuff." But to put it in more eloquent terms, you knew what people's positions were, and typically you could get a feel for if the exchange floor members had a big short position or had a big long position, and they all needed to buy them. And a good order would be, in regards to the participants on the floor, help them to get out of their position if they needed to sell them or if they needed to buy them.
Okay. What was the most profitable era during your 40 years in markets?
The most profitable era was in January of 1986, when I went to Barbados, and I would get the Wall Street Journal came by plane, but it came a day late. And that first 10 days of 1986, the market went up hundreds of points every day and blew out everybody in the ring. We'd never seen a vertical move like that before to the upside, and was the beginning of what in 87, they also did the same thing. And so by not being there, I saved myself. Most errors were predominantly negative. So in this case, one that I didn't make money, but I didn't lose money. And it completely blew my mind to see. And then when I came back to the exchange, a lot of my friends had lost everything and were gone. So
why is that? Because they hadn't seen a move like that before, thought it had gone too far, continually trying to short?
I mean, the question of why is always a trap. Why the market did something. I mean, our job as a trader is generally just to make sure you're in touch with where we're going, not why. So it was also, 35 years ago.
But what about this blew out most of your friends on the floor? The fact that they were trying to short this big
No. Think about it this way. If you're on the floor, the brokers, everyone's got buy orders, right? And you're standing there on the floor. And the brokers are like, who do they buy them from, right? And so essentially you get put into the position where you're learning to trade from the short side, because the only orders that are coming in are buy orders. So while you may be thinking that this is expensive and you're selling them at a ridiculous price, then when you go to cover them, it's like, oh no, you're the one paying an even more ridiculous price. So a lot of times, just because you're at the time in the ring, just because you were there, you were put into positions from a scalp perspective that you definitely didn't want, but you thought that you might be able to scalp them out for just a tick or two.
Okay, I understand. Yeah, man, what a good time to go on holiday.
Right. But I mean, there is the understanding that as we go through life, and a sort of a philosophical thing, that we are